Alright, so in this video, we're gonna cover Lesson 1 still, External Financial Reporting, and Section 2 is about the Statement of Financial Position or simply the balance sheet. So just to recap, we have here the full set of financial statements. First is the Statement of Financial Position or the balance sheet. Second is the Statement of Profit or Loss and other comprehensive income or income statement. Third is the Statement of Changes in Equity. Fourth is the Statement of Cash Flows. Fifth is the Notes to Financial Statements. And as mentioned earlier, this video will cover the Statement of Financial Position or the balance sheet. So to provide you an overview, here is the outline of this lesson. So first, we're gonna cover the purpose and the use of the Statement of Financial Position or the balance sheet. Second, I'm gonna discuss the components of the balance sheet. Third, I'm gonna cover the current and non-current assets. Fourth, I'm also gonna cover the current and non-current liabilities. Fifth, the equity and the equity transactions. Sixth, the format of the balance sheet. Seventh, the note disclosures, specifically pertaining to the Statement of Financial Position or balance sheet. Eighth, the limitations of the balance sheet. And lastly, the off-balance sheet financing. Alright, what is the Statement of Financial Position? This financial statement reports the assets, liabilities, and equity and their relationships at a point in time. So why is the balance sheet important? The main purpose of the balance sheet is to reveal the financial health of a business, take note at a specific point in time. So most companies report their financial statements as at end of the year or as at 31st of December. So how is the balance sheet used? Most users of the financial statements look at the balance sheet in conjunction with other financial statements to have a clear picture and to have a clear understanding of the relationships between different accounts. Now, a balance sheet is very important since it is used to first assess the liquidity of a company. Now, what is liquidity? Liquidity is simply computed as current assets less current liabilities. So by comparing a company's current assets to its current liabilities, we are able to have a clear picture of the liquidity of a company. So for instance, we're able to assess how much cash is readily available. So take note, in every company, liquidity is very important since a company has operations, right? So they have current obligations that they need to pay. Otherwise, they won't be able to operate. For instance, if they're paying for their offices, if they have employees, they need to pay wages for their employees. Also, they have operating expenses. Now, if they don't have available cash, then the company will have problems in terms of how they're able to pay them. So if they don't have available cash, then the company will face an issue in terms of having the ability to continue as a going concern or as a continuing entity. Second is efficiency. So basically, by comparing the income statement to the balance sheet, we are able to measure how efficiently a business uses its asset. So for example, by examining the balance sheet and the related income statement accounts, for example, the revenue, we can have an idea of how well the company is able to use its assets to generate revenue. Third is leverage. So leverage simply means the amount of debt that a firm uses to finance its assets. So through the balance sheet, we are able to understand how much leverage a business has, which also tells us how much financial risk the company is currently facing or will be facing in the near future. So simply by looking at the leverage, most users of the financial statements compare the debts to the equity listed on the balance sheet. Alright, so next is the accounting equation. So remember, I've also discussed this in section 1 of lesson 1. The accounting equation has 3 components. Assets is equal to liabilities plus equity. So basically, assets, some example of this include the cash in bank, trade receivables, other receivables, land and building, property, plant and equipment, inventories, and so on. For liabilities, for example, we have trade accounts payable, salaries payable, income tax payable, loans payable, and so on. For equity, it includes the share capital or the investment of the owners and the accumulated retained earnings. So take note, this equation is also based on the proprietary theory. In layman's terms, assets simply means what an entity owns. Liabilities means how much an entity owes. Equity means the amount invested in the business by the business owners. Alright, so now let's talk about the components of the balance sheet. So these are the definition based on the standards. So take note, assets, it refers to the resources controlled by the entity as a result of past events. Liabilities, these are present obligations of the entity arising from past events. Equity or residual interest in the assets of the entity after subtracting all liabilities. So these are the definition per standards. So you might encounter this in the MCQs. So just take note and familiarize the definition. And also take note that balance sheet items are permanent or real accounts. So what do we mean by permanent accounts? So permanent accounts are not closed at the end of the accounting period. So this is the opposite of the temporary accounts, which refers to the income statement items. So for balance sheet, take note, these are permanent or real accounts, meaning these are carried over from period to period. So basically, since we are reporting the balance sheet as at a point in time, the figures that we're seeing in the balance sheet are the cumulative balances which have been carried over from previous years. Now let's talk about the assets. So basically, for the classifications of the assets, there are actually two classifications: current assets and non-current assets. So for current assets, this is the definition per standards. Current assets are expected to be realized in cash or sold or consumed within the entity's operating cycle or 1 year, whichever is longer. Now, when we say entity's operating cycle, so some companies, usually, their operating cycle is beyond 12 months or more than 1 year. So for these companies who have assets, these are still considered as current assets. Take note, it means whichever is longer. So for some companies, they have short operating cycle. So if it is short, then all assets which are expected to be realized within 1 year are current assets. Now, some companies have operating cycles which are longer than 12 months or 1 year. So even if it's expected to be realized or consumed beyond 12 months, as long as it is within the company's operating cycle, it still qualifies as current assets. So we have here examples of current assets. First is cash and cash equivalents. So basically, cash and cash equivalents are the most liquid assets of an entity. So when we say cash equivalents, these are assets that are readily convertible into cash. So for example, we have money market instruments, short-term government bonds, treasury bills, marketable securities, and commercial papers. So take note, cash equivalents usually have a maturity within 3 months up to 12 months. In excess of 12 months, it's no longer considered as cash equivalent. Second, we have here receivables. So basically, receivables can be trade receivables and other receivables. Basically, accounts receivables represents the money owed by the customers to the company from a sale of products or services on credit. So more often than not, companies provide goods or services on credit. Once the goods have been delivered or the services have been rendered, the company already has the right to collect from the customer. Third, we have prepaid expenses. This asset represents the cash paid out for goods or services to be received in the later period. For example, I am a business and have contracted a service contract and I have paid in advance. I have this asset wherein I can expect that the related service will be rendered in the future period. So for the amount of cash paid to the counterpart, the company has the right to record this as current asset in the form of prepaid expenses. Fourth, we have inventories. Now for companies operating in retail industry, the goods that they are selling, for manufacturing organizations, inventories can be classified further into raw materials, work in process, finished goods, and goods for resale. Now let's proceed to the non-current assets. So this is the definition per standards. Non-current assets are long-term investments for which full value will not be realized within the accounting year. So take note, non-current assets, these are long-term investments which are expected to be realized more than 12 months or more than the length of the operating cycle of a company. So here are the main categories of non-current assets. First, we have property, plant, and equipment. Property, plant, and equipment are simply PPE. So these are tangible operating items recorded at cost and reported net of any accumulated depreciation. So example of property, plant, and equipment, for example, if the company has a plant for manufacturing, if it has certain furnitures and fixtures, equipment necessary for operating, then this is recorded under this account. And take note, items are initially recorded at cost and then subsequently reported net of any accumulated depreciation. So assets are usually depreciated using the methods used by the entity, either straight line method, double declining method, and so on. Next, we have land. Take note that land is the only asset which is not depreciable, meaning it is not depreciated for financial reporting or for tax purposes, simply because land typically appreciates. Third, we have buildings. So these are fixed asset account that contains carrying amount of the buildings owned by an entity. So typically, how do we record building? So for instance, the original purchase price or the cost of making the building plus the capitalized additions, if any, minus the accumulated depreciation and any subsequent impairments. So fourth, we have intangible assets. Intangible assets, these are non-financial assets without physical substance. So this is the type of asset which we cannot see, feel, or touch, and these are usually non-financial. So for example, we have patents, goodwill, and so on. Fifth, we have investments and funds. So these are actually non-operating items intended to be held beyond 1 year or longer of the operating cycle. So now let's proceed to the liabilities. Similarly, liabilities are classified into current liabilities, non-current liabilities. So here is the definition of the current liabilities per standards. Current liabilities are expected to be settled or liquidated in the ordinary course of business during the longer of the next year or the operating cycle. So take note, both current assets and current liabilities, these items are within the ordinary course of business. When we say ordinary course of business, these assets or liabilities are realized or incurred within the normal course of business or within the operations of the business necessary for generating revenue. So here are the major categories of current liabilities. So first, we have accounts payable, also called AP. So this account refers to the amount owed by the company to the vendors. For instance, if a company is acquiring goods and services from its vendors on credit. So most companies purchase materials or supplies or goods for resale on credit. So they record this as accounts payable. So we classify this as current liabilities since typically companies need to pay the vendors quickly or within 12 months or within its normal operating cycle. Next, we have notes payables, specifically the current portion. So notes payable is a liability account wherein a borrower records a written promise to repay the lender. So the difference between accounts payable and notes payable is that the notes payable is a written liability, Third, we have accrued expenses. This relates to the expenses that is recognized on the books before it has been paid. So, remember, based on the accrual basis of accounting, expenses are recognized when incurred regardless of when paid. When the company records the expenses when it is incurred, they have to record the corresponding liability, which is the accrued expenses. Fourth, we have the deferred revenue. It simply means a liability of a company when a customer has prepaid the amount for the goods and services which has to be delivered or rendered in the future. Fifth is the current portion of long-term debt, so it's understandable. Long-term debt usually have current portion or the portion which is maturing within 12 months. Sixth is income taxes payable. So this is also classified under current since most taxes are due to the government within 1 year. And take note that the calculation of the income tax payable is in accordance with the prevailing tax law of the company's home country. Next, we have non-current liabilities. So this is the definition per standard. These are the financial obligations that are not expected to be paid within 1 year. So we have here the major categories of non-current liabilities. First, we have long-term loans and notes or bonds payable. These are agreements a company enters into with another party, which typically includes a formal written promise to pay a predetermined amounts on specific dates. To be categorized as long-term, the maturity has to be longer than 1 year or longer than its operating cycle. Long-term lease obligations. So we have the new standards, which is the IFRS 16, which requires a company to record the right of use assets and the lease liability. So the long-term portion of the lease liability should be classified under non-current liabilities, and the current portion should be classified under current liabilities. Third, we have deferred tax liabilities. So this refers to the tax that is assessed or is due for the current period but has not yet been paid. Meaning, this is the amount of tax that will eventually become due in the near future. This comes from the difference in timing between the tax which is accrued and the tax which is paid. Pension obligation. So usually a company has certain employee benefits, right? So long-term employee benefits. So a company has to recognize this pension benefit obligations under non-current liabilities since, of course, the company expects it to be paid not within 12 months. So the present value of the retirement benefits earned by the employees are recognized under pension benefit obligation. So usually, the valuation here is kind of complex. So it is usually determined by an actuary based on a number of assumptions, including the estimated future pay rises and so on. Now let's go to equity. So this is the definition per standards. So it is the residual interest in the assets of the entity after subtracting all the liabilities. So just remember the accounting equation, right? Assets is equal to liabilities plus equity. Now, if we rearrange this equation, it will be, if you put these liabilities on the left side, of course, now becomes assets less liabilities is equal to equity. Meaning, what is remaining after we deduct the liabilities from the assets. So, equity, typically referred to as shareholders' equity, it simply represents the amount of money that would be returned to company shareholders if all the assets were liquidated and all the company's debt was paid off in case of liquidation. So next, let's proceed to the major items of equity. First, we have capital contributions by owners. So it simply means the amount of money or assets given to a business or partnership by one of the owners or partners. So for example, the investment by the owners. Second is retained earnings, which means the amount of net income left over the business after it has paid out dividends to shareholders. So usually a company has profit or loss during the year. Remember, I've mentioned earlier that income statement accounts are temporary accounts or nominal accounts, wherein each year these temporary or nominal accounts are closed. Usually, these profit or loss or income statement accounts are close to retained earnings. So what happens here is the retained earnings is the cumulative amount of profit or loss during the year and prior years, and then deducted here is the dividends paid to shareholders. Third is the treasury shares. So treasury shares are shares which are bought back from stockholders by the issuing company. So once the company has reacquired the previously issued shares, these treasury shares are no longer outstanding and hence are not included in the distribution of dividends or the calculation of the earnings per share or EPS. Fourth is the accumulated other comprehensive income. So comprehensive income includes revenues, expenses, gains, and losses that have yet to be realized and are excluded from net income on the income statement. OCI represents the balance between net income and comprehensive income. So here is an example of a format of balance sheet just so you can have an idea about the structure of a typical balance sheet. So as you can see here, in this box, color red, we have the current assets. So observe the items included under current assets. We have cash and cash equivalents, accounts receivable, inventory, prepaid expense, investments. Then we have here items which are classified as non-current assets. We have land, building and improvements, equipment. Then we less accumulated depreciation. Then we deduct the accumulated depreciation from the equipment. Then we have intangible assets under non-current assets, and take note, intangible assets are also amortized. Hence, we deduct the accumulated amortization. Then we also have the current liabilities. So observe the items included here: accounts payable, notes payable, accrued expenses, deferred revenue. And we have long-term liabilities or non-current liabilities, the long-term debt. And for equity, you have common stock or common shares, additional paid-in capital or share premium, retained earnings, and treasury stock. Note that total assets and then total liabilities plus shareholders' equity, the amount should be balanced. That's why it's called balance sheet, right? In preparing the statement of financial position or balance sheet, the challenge here is to have this balance, since usually in the retained earnings, we close here the amounts from the statement of profit or loss or the net income or loss during the year. Alright? So here are the notes disclosures under the statement of financial position. So what are notes disclosures? These are supplemental notes to explain the basis of presentation and accounting policies used in the financial statements. So we include in the notes to financial statements the basis of presentation as well as the accounting policies we have used for some of the balance sheet items on the face of the financial statements. So here are the common note disclosures which are specific to the balance sheet. We have cash and cash equivalents, we have trade and other receivables, we have inventories, we have prepaid expenses, we have investments, we have property and equipment, we have land, we have intangible assets, accounts payable, accrued expenses, deferred revenue, notes payable, loans payable, lease liabilities, share capital, and retained earnings. So here are the limitations of the balance sheet. First, balance sheet is presented at a specific point in time. So why is this a limitation? So as mentioned earlier, the balance sheet is prepared for a specific time period, normally as at end of the year or normally as at 31st of December. So it's a limitation since looking at one period only could be misleading. For example, if there have been seasonal impact on the business, economic ups and downs, and etc. Hence, it's always advisable to look at 2 to 3 periods or even more if we wish to have a true analysis of the affairs of a company. Take note that there are so many factors which are affecting the business throughout the year, and the balance sheet only is a snapshot or a picture of the status or financial health of a company as at a particular period, so it's a limitation. Second, the balance sheet is recorded at historical cost. So this is a primary limitation as well, since items recorded in the balance sheet are based on historical cost, meaning it disregards the impact of inflation. Third is that balance sheet is not comparable. So for checking the performance of one company, it is usually common to compare it with other similar company of the same sector. So why is this a limitation? It's simply because financial statement just give an indication and does not facilitate true comparison between two companies. So for example, one company may have different accounting practices, accounting policies, while other companies have different accounting policies as well. So more often than not, the figures are not comparable. Fourth, balance sheet ignores non-financial matters. So as we all know, successfully running a business is not limited to sales, expenses, and profits. There are a lot of other factors as well to be considered, such as environmental factors, sociological, political factors, competitive situation, marketing, and so on. These factors are ignored in the financial statements. Then lastly, it requires estimates and management judgment. So last topic, of balance sheet financing simply means financing that is not recorded in a company's balance sheet. First is factoring receivables with recourse. Now, when we say factoring receivables, meaning the company has sold its receivables to a third party or to a finance company. When we say with recourse, it simply means that the company who sold its receivables is still contingently liable to the finance company or to the third party in case the debtor defaults. As such, the factored receivables or the sale of receivables to the finance company is not recorded by the company. Hence, it is termed as off-balance sheet financing. Second is special purpose entities. So for example, a firm may create another firm for the sole purpose of keeping the liabilities associated with specific project off of the parent firm's books. For example, if a parent company has certain projects or expansion plans, and of course they need financing, some parent companies, they create these special purpose entities wherein liabilities are recorded in these special purpose entities and are not reported on the balance sheet of the parent company. Hence, this is also one form of off-balance sheet financing. Third is joint venture. So it is off-balance sheet accounting since the joint venture is accounted for on equity method. Hence, the liabilities of the joint venture, for example, are reported on the joint venture's books. So the debts are not reflected as debt of the members of the joint venture. So it is also recognized, so it is also considered as a form of off-balance sheet financing. So I hope this has been helpful to you. Comment below if you have further questions or clarifications, and I'll be more than happy to answer them. My name is Jane. Thank you for watching. If you like this video, hit like, share, and subscribe. Till next time.